Why building credit matters more than you think. It's not just about getting a loan, whether you can qualify, or getting a good interest rate, although that was the primary purpose of the credit score. Now it's being used for much more than that. Did you know your credit score is also used for things like to determine your insurance premiums or whether you're able to rent or not? Some employers care, and your credit score may determine whether you get that job or not. You see, credit score is really a risk score. This determines how risky you are to make your payments, pay back a loan. The purpose of the credit score is to determine whether you're going to repay that loan or continue to make your payments. It's just a risk factor. It's a numerical equivalent. You see, the credit score is a numerical value helping to predict whether you're going to make your payments or pay back your loan. Okay, let's talk about a thick versus thin file and what that means. An example of a thin file would be if you got one credit card 4 months ago and only made 3 or 4 payments. So you would have a short credit history of 4 months, and then your transactions or your trade lines would only be 3 or 4 trade lines. So you would have very few data points to be calculated in your score. This is an example of a thin file. An example of a thick file would be if you had multiple credit cards or lines of credits spanning over years. The years will give you a long credit history, and each one of your credit lines will give you a transaction line. So this gives a lot of data points to determine your borrowing or credit worthiness. Okay, let's touch on the two most popular credit scoring systems. One is FICO, the other is Vantage. FICO is your industry standard. This is the one that the banks and lending institutions prefer. Like 90% of them use this to determine whether you're going to get the loan or not. The other one is Vantage. Vantage is weighted completely different. It's a different scoring system, although it does use the same range. Both of them are 300 to 850. Vantage is often found when you use your free credit check apps like Credit Karma. When you're using those apps, this is the Vantage score. This is not your lending score. Just know that there's a difference. Okay, now let's talk about FICO and its 5-factor modeling system. This is what determines how they calculate your score. The first one is credit history. This one's going to account for 35% of your score. So this is a huge deal. This is the biggest factor in determining your credit score. What they look at is, do you make your payments on time? That's it. This is the single most important thing for determining your credit score. The second most important factor is credit utilization. What credit utilization is it takes all your revolving credit, your limits, and then compares that to how much you're actually borrowing. So if you have a limit of $100,000, but you're only borrowing $10,000, that's a 10% credit utilization. Now, it looks at 2 parts. One, your total revolving credit is factored. The other one is each individual line of credit. So each credit card, what's your utilization there, and then all your credit cards and what's the total utilization for all of them. So those both matter. A good way to optimize is to keep it under 10%. So 1 to 10% is optimal. 30% is your general rule of thumb, and beyond that you start to have negative impacts. So keep your credit utilization low. The third most important factor in your FICO score is credit history. This one accounts for 15% of your score. What it looks at is the length of time of your average revolving credit. So if you have one credit card and you had 10 years, that would be a 10-year credit history. However, if you opened up a new credit card today, it would average the two of those out and you would have a 5-year credit history. So when opening up new lines of credit, be strategic about it. It doesn't mean it's a bad thing, just have a plan. Okay, the fourth most important factor in your credit score is inquiries. This accounts for 10% of your score. An inquiry is when you go and apply for a new loan or have your credit checked, this is an inquiry. This will temporarily drop your score. It's not long lasting, but it does affect your score. All right, now the fifth factor in your FICO score is your credit mix. This one also accounts for 10% of your score. What FICO is looking for is the mix of your installment loans versus your revolving credit. Remember, your revolving credit is like your HELOCs or your credit cards. You have a limit to which you can borrow. You can pay it back, and that opens up your limit again. Then you can borrow it, and you can pay it down. That's revolving credit. Installment credit is where you borrow, and as you pay it down, it does not increase your limit. You cannot reborrow that money. So credit mix looks at a balance of your revolving and your installment loans. So the credit scoring system prefers predictable borrowers. It rewards certain behaviors like consistent on-time payments, moderate credit utilization, stable account history with a diversified borrowing mix. And it penalizes you if you have high balances or high utilization, late payments, a lot of new accounts or inquiries in a short period of time, or a thin file if you have a very short to no credit history with very few transactions. Okay, so let's talk about how long some of these things affect your credit. Let's start with late payments. Late payments got to be by far the worst thing you can do. Late payments will negatively affect your credit for up to 3 years. This is why I can't stress enough, make sure you're never late. Ideally, automate your payment. If you got a credit card, you got some kind of payment, some kind of loan, any kind of loan, revolving, installment, anything, automate it. It's the best thing you can do, including rent, because rent now gets reported on your credit report. So when you're late on these things, they'll negatively affect you, and sometimes up to 3 years. Okay, the next one is credit utilization. If you have a really high balance, the good news is this one's easy to fix. You just pay it down. I know, easier said than done. But if you were to pay that thing down, your next statement, your reporting statement, will affect your credit score. It happens that fast. Credit inquiries. So when you open up a new account or you just apply for a new account, that's going to show up for about a year. So that's going to have a negative impact, but it's pretty short-lived. It's under a year. And if you open a new account, you're starting to build new credit history and increase your utilization or your limit, lowering your utilization. So it's not necessarily a bad thing. That's why it's a small percentage of your credit scoring factor. Collections. Collections is a bad one. Collections can be like 7 to 10 years it shows up on your credit report. Now, the negative impact does fade, but it is still a negative and it does show up on your report, so that can affect how your score is or how your potential lender views you as a risk. Once you understand what the credit scoring system cares about, time, predictability, usage, and mix, the credit scoring tools we're about to cover will make sense. One way to rapidly improve your credit is by becoming an authorized user. What an authorized user is where you basically piggyback on somebody else's credit. Say you have a friend or a family member with a good credit history, is good and responsible with their credit. They can put you on their credit card as an authorized user. This doesn't mean you have access to the card. You may not actually get a duplicate card. They may just have you on as an authorized user to help improve your credit. What this does is it imputes all the benefits and negatives onto your credit. So, credit limit, credit history, payment schedule, and utilization all get attributed to you. So if they're a good borrower and make their payments on time, that will help your credit immediately. The converse is true though. If they miss payments, they have high utilization, that affects you too. So be careful with that. Okay, a couple alternatives to this, but along the same line, are trade lines. Trade lines is another popular one. It's basically a company that goes out and sells credit history, like an authorized user. They're kind of frowned upon, not a lot of people like them, and they can be expensive and have temporary benefits. Another one is credit sponsor. A credit sponsor, also short-term, frowned upon, definitely. Borrower or lenders do not really like them, but they work in the same way. They put you on their credit for a fee to improve your credit or show a greater balance in that case. And this is supposed to help you acquire your new loan without putting them at risk. They make a little bit of money, you achieve your goal. That's how it works. Be careful with those because they can be considered red flags, and it's definitely in the gray area. Whereas a straight authorized user is considered more legitimate. Make sure it's somebody you know, a family member. That's the ideal way to do it. Another easy thing you can do is get a secured credit card. This will allow you to build credit, and it's easy to get approved. Typically what you do is you go to your major bank or credit union or credit card issuers. There's a lot of places that do this, but just go to your bank, wherever you're banking now, and say, I would like a secured credit card. And you can do them with as little as $200 down. So you put $200 down, they issue you a card. Usually they don't pull your credit or anything because your deposit is your security. And then they give you a credit limit up to your deposit. So now you can take this card, go use it as a regular credit card. However, all the same credit card rules apply. Utilization, payments, credit history, and on-time payments. These are very important. You've got to make your payments. You got to keep your utilization low and be responsible with this card. Treat it just like a regular credit card. The purpose of this is to build credit. One really cool thing about these is if you do this after a period of time, usually 6 months or so, you can graduate to an unsecured credit card. So in other words, it turns into a traditional unsecured credit card. You get your deposit back, your limit usually goes up, and you keep all that credit history from the time you started this. It's a great deal. Another way to do this is with a credit builder loan. A credit builder loan is a small installment loan designed to help people build or rebuild credit. Unlike a normal account, you don't get the funds up front. Instead, what they do is they place the money into a deposit account and you make small payments towards it. Once you complete the term of the loan, you get the funds. So it's kind of like a traditional loan, but in reverse. This structure creates positive installment history for you at no risk to the lender. So they're okay with doing this. They make a little bit of money on the interest and whatever small fees they attach, and you get the benefit of all the credit history you built. So how do you obtain one of these? You go to your local bank or credit union, you let them know you want a credit builder loan, you deposit money. You can do it with as little as $300 or a couple $1,000s. They take the money, they place it into a locked account, they write the loan, you start making payments. It's usually for 6 months, 2 years, and at the end of the loan, you get your money back. Now you had the benefit of an installment loan, but I would caution you, make sure you make all the payments because that credit history matters. It counts. Ideally, set up an automated system where you automate the payments so you never forget. Having no late payments, big benefit. Late payments, ouch, that's gonna hurt. Okay, now this next method is not one of my favorites, but it's out there, so I'm gonna tell you about it. It's called the subprime unsecured credit card. A subprime unsecured card is designed for people with damaged or really, really bad credit. So not your ideal starter card. You're better off with a secured card with that. I don't know why you can't use a secured card for this, but maybe your situation doesn't allow that, and so this is your only option. Either way, this is a thing that's out there, so I'm going to tell you about it. Unlike a secured card, you do not have to put down a deposit to obtain one of these. However, the annual fees and the monthly fees can be quite high, and the interest rate at APR tends to be high as well. They are sometimes called fee-based starter cards or fee-based harvester cards, mostly because they're expensive. To get one of these, there are financial institutions that focus on subprime lenders. Also, major credit card companies have these rebuilder programs, so you can often get these cards through them. To get approved, you generally do have to go through a credit approval system. Seems kind of funny, I know, because your credit is trash, terrible, it's bad, but still somehow they want you to go through this. I don't know, I don't make the rules, I just telling you how it is. They're often very small limits, So you can get just a few $100s, maybe $1,000, and that's generally about all you get with these things, which is probably a good thing, because if you have a problem with credit, you don't want a big limit because you can get yourself back into trouble. At least with a small limit, you can learn some good habits and try to recover and build your credit again. The annual fees tend to be quite high. Sometimes there's monthly fees, maintenance fees, these kind of things. Your interest rates or your APRs tend to be quite high. However, the way to avoid high interest rate is pay your card off completely every month. So before the due date, if you just pay the entire balance off, you don't pay interest. That's one good way around that. Then all you have to worry about is the annual fee or monthly fees, but at least the high interest rate is gone. Keep in mind, credit card rules apply. Keep your purchases low. Keep your utilization low. Don't max out this card. Use like 10% of your available balance. So tiny, small purchases. Pay it off at the end of every month. Pay on time. And you'll build your credit. You'll repair things. You can do this. Here's another one. Rent and utility payments can help your credit. All you have to do is make sure they get reported to the credit bureaus. This is particularly good for people with little to no credit. So if you're out there, you're just getting started and you need to build credit, make sure your rent and your utilities are reported to the credit bureaus. Not all landlords and utility companies are required to report to the credit bureaus, although this is changing. Some places it is mandatory, and some places smaller landlords don't have to report it, smaller utility companies, but it is becoming more common. If you're in one of those areas that it's not mandatory, or your landlord or utility is not reporting it, you can enroll in a third-party service that does report to the credit bureaus that you're making your payments on time. It's not a bad idea to ask your landlord if they report to the credit bureaus. They'll either say yes or no. Either way, it's okay. If they say no, get a third-party service to do it. A lot of places, like I said, do require it, so they have to report it, and they'll let you know. Making sure these things are reported really helps, because this is a part of your payment history. So in other words, if you're making your payments on time, this is that part that's 35% of your credit score. It's a huge part. It's the single greatest factor in your credit score. So if you can get these things reported, big bonus. Good job. Another one is your retail cards or store cards. These are closed loop cards, so they can only be used in the establishment that they are issued. Unlike a general bank, where a general bank you get a card and you can use that anywhere, with these closed loop cards or retail cards, you can only use them at their store. One reason why you may want one of these store cards is because of the loyalty program or the reward program. A lot of times they offer you a discount or a continuing discount as long as you use their card in their store. The disadvantage is they tend to come with lower limits and higher APRs. But you can mitigate that as long as you just pay it off. So if you use the card in the store, you get the discount, you pay it off, sometimes it can be a win. With these cards, they are credit cards, so the same credit card rules apply. Make sure your payments are made on time. Credit utilization is low because it will affect your credit. It does count as a part of your overall utilization and your overall credit score. Disputing inaccuracies on your credit report. Credit reports sometimes contain errors. Sometimes they have missed payments, incorrect balances, wrong accounts, duplicate accounts, and sometimes accounts that don't even belong to you. Disputing does not remove legitimate negative items on your credit report, but it does remove mistakes. One of the ways they do this is you dispute this, they have to verify it. If they cannot verify it, they need to remove it. Okay, so how do we do this? First thing we need to do is we need to download our credit report from all three bureaus. Then we need to identify all the mistakes, find all the outdated or inaccurate data, submit a dispute to each of the credit bureaus. The bureaus investigate these disputes, typically within 30 days. The credit bureaus reach out to the creditor to verify the account and the information. and then they make the corrections on your report. You are legally allowed to pull your own credit report, and pulling your own credit report does not have a negative effect on your score. There are two types of credit pulls. There is a hard pull and a soft pull. The soft pull is generally just to view and look at credit and do a background check. That's generally all the pulls are used for. A hard inquiry is when you're applying for credit. If you're trying to get a credit card or a loan, that comes with a hard pull, and that does affect your credit. Now, it's a small hit and it's temporary and you do recover, but it is a negative impact. So it is good practice to pull your own credit. Soft pull does not have a negative impact. You can do this through the federally authorized site, annualcreditreport.com. Request a report from all three major bureaus, TransUnion, Equifax, and Experian. When you pull this credit report, look for the accuracy, look for the completeness, look for derogatory reports. Find all the mistakes so that we can dispute them. It's a good idea to monitor your credit report periodically to make sure things are accurate. Identify missing trade lines and thin file situations. Catch reporting errors early. Check utilization on revolving accounts. Confirm that new credit building tools are reporting accurately. Avoid unnecessary hard credit pulls. Strategically time new credit applications. Track progress as new trade lines age. You can also sign up for third-party monitoring services. Sometimes it's worth it. It's a way to automate things, and they notify you when something changes or goes wrong. Kind of a nice thing. So, key distinction between hard pull and soft pulls are: soft pulls are for viewing credit, background checks, pre-approvals, and does not negatively affect your score. Hard pulls are when you're applying for credit, new credit cards, mortgage, car loans, this type of thing, and does temporarily affect your credit. Credit scores reward borrowers who responsibly manage different types of credit, specifically revolving and installment credit. Managing both types of credits creates a stronger credit profile than it does if you only managed one or the other. So how do we implement some of this? Well, if you're a brand new credit user or have little to no credit, one of the things you can do is start by getting a secured credit card or the subprime credit card. Adding a store card or retail card can help add some depth to your revolving credit. May not be necessary though. So that takes care of revolving credit. Now you need an installment loan. So if you don't have a loan already, like a car loan or something, then maybe what you do is you go get a credit builder loan. Now that you have both types of credit, revolving and installment loan, maintain these for a year or two, and that'll drastically improve your credit score. In addition to that, if you're trying to repair, rebuild, or further improve your situation, what you can do is make sure you pull your credit report. Address any inaccuracies. If you let revolving credit lapse, open up a new one. If you don't have an installment loan already, like a car loan, student loan, something like that, get a credit builder loan. Maintain both revolving and credit responsibly. Make your payments on time. Keep your utilization low and avoid closing revolving credit loans. So if you have a credit card, don't close it. If you're going to not use it, just don't use it. Put it away, cut it up, do whatever, but don't close it. Closing that account will hurt your credit. It limits your credit history. You're better off just leaving it alone. Exceptions to this would be if there's a high annual fee or there's some maintenance fees you need to get out of. That might be the exception, but otherwise, if you can, it's better to leave it open. I want to remind you that this is not financial advice. You should never take financial advice from any random person online. But I want to thank you for making it this far. I hope this information you find helpful. Follow for more.